There's rarely a home we pass on. We always will make an offer, but sometimes the offers are so bad that it might as well be a pass. And for us, it's going to be crime ridden areas. It's going to be places where the rents are going to be $300 a month, and anything under $1,000, we joke, if it's 300 a month, you're going to have 300 a month problems. That's kind of our joke in our area. And there's areas obviously we don't want to be in. For me, our long-term hold, I didn't want to be a slumlord. I've been told before, any home you choose to rent to someone else, be prepared to live in it, because one day you might have to, which I've always kind of liked that mentality. Don't rent a house to someone I wouldn't be willing to sleep in myself. And so we've tried to pick areas that have doubled in value over the last 7 to 10 years. Now, this last 7 to 10, the shift isn't probably a fair comparable, but typically a neighborhood where it normally will double every 7 to 10, with the idea that over the next 7 to 10 or the next 20, by the time our notes paid off, that house will have doubled or tripled in value. So like on your 30-year notes, you probably haven't even considered this, but in 30 years from now, those houses could be your 5X of what you put them under contract. So you could keep refining or just take all, be at a full 100% equity position, and the sky's the limit as those grow in value.
Yeah, absolutely. And so with ours, we kind of look at properties based off location as kind of like, I don't want to say short-term rentals because that's not like Airbnb, but basically 7 to 10-year rentals and like kind of legacy rentals, right? So the ones that we see as super highly desirable assets, particularly our multifamilies, we kind of consider those to be legacy assets because we know that some point down the line, there's going to be another investor that wants to buy a cash flow rental property, right? But then we look at a lot of the single families that we own, especially the ones that are in like more C-class areas. There is potential there. And just because we're buying it and setting up for your rental doesn't mean we have to keep it forever, right? So we basically are looking at those as like, those are going to fit our needs right now. We're able to pull all of our money out. The area is gentrifying. We are cash flowing on it. So let's hold it for the next 5 to 10 years. And then once this area has continued to gentrify, we'll be able to sell this property for significantly more down the line. To like as families and stuff are starting to move, there's becoming less of a rental neighborhood.
I love it.
And we'll do other things as well, like with those same types of areas where instead of doing them purely as rentals, we'll do like lease to owns, where they're sort of required to pay us a pretty large down payment to get extra money out, and then they're responsible for the maintenance. We've done like seller wraps on stuff where we keep our mortgage and we basically issue them a second mortgage that they're required to pay. And that way it takes away a lot of the liability of us having to, manage it as like a landlord, but still has the cash flow and the tax upside and, everything else that we have. And basically we just lose out on, potential appreciation on it in that sort of situation. But with some of the dog properties, it just makes sense to do that.
I love that. I love lease to own. Your people feel like it's their house. It's land contracts. I feel like I've done a few of those like 10 years ago as well. I like that. Most people will never finish it and close on it, and they'll miss a payment and you'll get it back. Not that that's your goal. Your goal is that they treat it like it's their own property.